Joint Venture Checklist Item Number 13. How will you split the profits from your joint venture promotional efforts? Money clarity prevents partnership conflict. Before launching any joint venture, you must define exactly how revenue will be divided. Unclear financial terms create resentment, mistrust, and unnecessary friction. The profit structure should reflect contribution risk resources and long-term value, not emotion. Number 1. Equal split 50-50 model. A 50-50 split is common when both parties contribute comparable value, such as similar audience size, workload, brand equity, and operational responsibility. This model works best when roles are clearly defined and contributions are balanced. Number 2. Weighted contribution model. Not all partnerships contribute equally. One partner may bring the audience while the other builds the product. One may handle fulfillment while the other manages marketing. In these cases, a 60-40, 70-30, or performance-based split may be more appropriate. Number 3. Multi-level, using tiers, performance structure. Some ventures use tiered payouts: 40% base commission, 50% after $50,000 in sales, 60% after $100,000 in sales. This rewards performance while protecting downside risk. Number 4. Front-end versus back-end revenue. Clarify whether the split applies only to the front-end product or also includes upsells, recurring subscriptions, back-end offers, or lifetime customer value. Many conflicts arise when partners assume back-end revenue is included when it is not explicitly defined. Number 5. Cost allocation before split. Will expenses be deducted before profit distribution? Advertising costs, platform fees, software subscriptions, affiliate payouts, and transaction fees should be clearly accounted for before calculating net profit. Number 6. Ownership and intellectual property. If partners are co-creating an asset, define who owns the intellectual property. Is ownership shared equally? Can one partner continue selling the product independently after dissolution? Number 7. Payment processing and reporting transparency. Define who controls payment processing systems and how revenue reporting will occur. Monthly statements, shared dashboards, and written payout schedules build trust. Profit split decision matrix. A joint venture profit split decision matrix provides an objective framework for determining equitable payouts based on specific contributions such as lead generation, content creation, and administrative overhead. By assigning weighted values to these variables, partners move beyond arbitrary handshake splits and establish a formula reflecting actual market value. This data-driven approach prevents resentment and ensures the venture remains financially sustainable for both parties over the long term. Audience contribution level: low, moderate, or high. Product creation contribution: low, moderate, or high. Operational workload: low, moderate, or high. Financial risk taken: low, moderate, or high. Brand equity exposure: low, moderate, or high. Higher contribution and higher risk should justify higher percentage participation. Common profit split mistakes. One of the most damaging mistakes in joint ventures is defaulting to a 50-50 split without accounting for the actual distribution of labor resources and overhead costs. Partnerships often suffer from internal bleeding when one party feels their disproportionate contribution is not reflected in the payout. Resentment builds and projects stall, agreeing verbally without documentation, ignoring back-end revenue definitions, failing to account for expenses before distribution, letting ego drive percentage decisions, not planning exit or buyout formulas. Quick profit structure checklist. Is the split proportional to contribution? Are back-end revenues clearly defined? Are expenses allocated before distribution? Is reporting transparent and scheduled? Are ownership rights documented? Profit clarity protects partnerships Clear agreements prevent future conflict.